He built a company, sold it, and then got into the commercial real estate space, and then after commercial and multifamily into self-storage.
The market speculation has just gone crazy in the apartment realm. Cap rates have already compressed, doubling the value of their asset, even if they remain mediocre.
But he did say that some of the large-scale multifamily properties are at the most risk because I think of what you're talking about.
But now it's like they have software, apps that'll allow you to do it from your iPhone or Android. You can rent your unit there.
Is there anything that's done to enhance the value of these things? Or you're just like, here you go. We're just boosting your price up.
The next path, the sixth path, is one of my favorites, and that is passively invest. If you've got cash flow or if you've got cash available and you don't want to continue to do hands-on.
So you mentioned it a few times, creating funds and gathering, I guess it's almost like crowdsourcing, right? So can you talk about putting a fund together and how you get people on board to jump into specific investments?
When I sold my company 25 years ago, I woke up with a couple $1 million in the bank the next day. And
what do you want your legacy to be? Why do you do this every day? It's not easy.
Welcome back to the Weekly Juice Podcast. As always, it's your boys here with another episode for you. Today we had on special guest Paul Moore. He is the co-founder and CEO of Wellings Capital. He's also an investor and author of the Bigger Pockets published book, Storing Up Profits, Capitalize on America's Obsession with Stuff by Investing in Self-Storage.
Yeah, Paul's been a guest on over 200 podcasts. We learned that today, but he sold a company. And he was able to generate a lot of profit from doing that. He told us in the episode it actually didn't make him that much happier, right? But he built a company, sold it, and then got into the commercial real estate space, and then after commercial and multifamily into self-storage. And self-storage was his thing. So he wrote a book on it. And you and I are kind of a little bit interested in self-storage in the sense of we've heard that it's low maintenance. The barrier to entry is actually not that high because there's a lot of mom and pop owners. And Paul explains that in the episode. He kind of gives us a masterclass, straight up on just how self-storage works, why people, how to get involved and how people are not really looking at it. And his book it's a Bigger Pockets published book. So it's a really, really good book. And you can tell this guy just really knows what he's doing. He's been doing it for a long time.
Couldn't agree more. Without further ado, let's bring in Paul Moore. Paul, officially welcome to the Weekly Juice Podcast. Corey and I are thrilled to have you on the show. You've come highly regarded, and we are very intrigued to share your story with our listeners. So thanks again.
That's great to be here, guys. It's really an honor.
Cool. Thank you. So if you could give a little brief background on yourself, who you are, where you're from, and then how you got into real estate investing.
Yeah, so I had an engineering degree and an MBA, and I went to Ford Motor Company in Detroit at the headquarters, but I wasn't really a big company guy, even though I really enjoyed Ford. I started my own company, and after 5 years, sold it to a publicly traded firm. That was 97. And I decided to start investing in real estate. And I thought, I'm a full-time investor now. This is pretty cool. And when I figured out, though, after a while, I wasn't really a full-time investor. I was a full-time speculator because a lot of what I did was investing, but some of what I did was, honestly speculating. I kind of, now I look back and think, investing is when your principal is safe and you got a chance to make a return. And speculating is when your principal is not at all safe and you've got a chance to make a return. And so got involved in single family residential, then rental properties, and did some ground up houses, did a subdivision, flipped a whole bunch of waterfront lots at a resort area. And over the years, I was trying to figure out how to get involved in commercial real estate, but I wasn't sure where the on-ramp was, who to trust, how to get started. And eventually built a multifamily asset, which we operated for a number of years in North Dakota. Then we did another one. And I decided I wanted to stay in multifamily. And I wrote a book called The Perfect Investment. But I concluded it wasn't perfect if I had to speculate to get there, and that's what apartments were feeling like for me. And so we made a transition, which we can talk about on the show, but that's my background.
Yeah, awesome. And I know that we can transition into the self-storage, which is you wrote a book recently in 2021, it came out about self-storage, and we can talk about that. But I want to touch on the multifamily and why you think that you were speculating versus investing. Like, what was it about that? Was it just the way you did analysis, or what are the things that you learned to change over kind of from speculation to the actual investment?
Yeah, I breezed over that a little bit, but I mean, so now, I mean, when I turned 50, I really did not like the idea of speculating anymore. And specifically in multifamily, speculation was not because of something I was doing wrong. I just felt like the whole market has gotten to a place in the last several years where people are counting on inflation. People are counting on, rents rising a certain amount. People are counting on all these exogenous factors, like cap rate compression and things outside of their control. And when you're counting on things outside of your control, and when you're hoping everything, for everything to go right to make a deal work, that really gets into the realm of speculation for me. And so that's what I meant when I said that, because I'm not saying all multifamily operators are doing that. Not at all. I mean, we're investing in multifamily right now, but in general, the market speculation has just gone crazy in the apartment realm.
Yeah. So we've talked to a number of investors, including the one who mentioned this, sticks out in my head, Michael Zuber, who's known for like one rental at a time. I think he has 250 units or so, but he does a lot of single family. And he most recently told us that that he doesn't see that there's going to be this big crash in the real estate market. But he did say that some of the large scale multifamily properties are at the most risk, because I think of what you're talking about, like just the people betting on the continuous rise of appreciation, which has happened for the most part. But obviously, if you play in those big numbers, you're at maybe more of a risk of a larger, steeper decline. So I think that's interesting. But what I want to talk about here is you wrote the book, Bigger Pockets published book, and it's called Storing Up Profits, Capitalize on America's Obsession with Stuff by Investing in Self-Storage. So what was it about self-storage that intrigued you specifically? Like, why did you decide on that move from multifamily to self-storage?
So a number of years ago, like I said, we saw multifamily getting overheated, and I don't think I could have put it in these terms at the time, but what we were looking for was an asset class that had a lot of upside, an asset class that had a lot of mom and pop owners who were aging, willing to sell. And we found that in self-storage. There are 53,000 self-storage assets in the US, and about 3/4 are owned and operated by independent operators. And about 2 out of every 3 of those independents are mom and pop, which means they typically have one asset. And these mom and pop operators can be good operators, but often they don't have the desire or the resources or the knowledge to increase income and to maximize value for investors. Heck, they don't have to. Cap rates have already compressed, doubling the value of their asset, even if they remain mediocre. So the first thing out of many that we can talk about that I loved was this fact that there are so many mom and pop owners. And I mean, with 53,000 assets in the country, like I said, that's the same as Subway, McDonald's, and Starbucks combined. Yet a lot of them are available for really making something great out of. There are so many ways to increase value in self-storage.
Yeah, I love that. And I've thought about getting into self-storage myself. Just I'm glad I'm talking to you, because I think it's a great segue into like the ins and outs of it. So maybe for people who don't understand self-storage, we can maybe back up a little bit and just give us the high level of what it actually is. I mean, for me, I'm picturing like, I know there's a Mr. Storage down the street. Now that may not be a mom and pop anymore. I don't know how big they are, but like you're talking about somebody who rents out a 10 by 10 space. I don't know if that's big or small. And then they can literally store their stuff in it. And they rent it out for, I don't know, $100 to $500 a month. You just give us the low and high about like, am I hitting the notes there on that?
Yeah. I mean, self-storage started in the late 60s. And basically, it was in the oil fields. They were looking for a place to store their equipment and stuff. And it's amazing. There are no other countries in the world except the United States and then maybe some Canada that have self-storage, or that have a commercially viable industry of self-storage. Americans are obsessed with stuff, right? And which that means that self-storage is doing well typically during economic downturns and upturns. Think about it. In upturns, in good times and booms, people are buying and filling up their Walmart cart and their Amazon cart, and their businesses are growing, and they're looking for a place to store their stuff. In bad times, and this is proven true more than I ever dreamed it would during COVID, people are, they're downsizing, they're moving, their businesses are shutting down, and like bars and restaurants shutting down. They're looking for a place to store their stuff. And so it really is amazingly recession resistant. Another thing we love is the prices are inelastic. Think about it. If I'm renting $1,000 apartment and you raise my rent by 10%, I might leave rather than pay an extra $100 a month, $1,200 a year. But with self-storage, the leases are month to month. And if you raise my rent by 10%, I'm paying $100 a month. I'm probably not going to spend a weekend, rent a U-Haul, get my friends together to move my my treasures down the street just to save $10 a month. And so it's sort of a high switching cost. Once you fill up your facility, often, people stay. And the cool thing is inflation, there's no better place I know of to capture inflation than in self-storage. I guess hotels would as well, but think about it. If I have a long-term lease on an industrial property or a Walgreens or something I'm leasing out, how do I capture inflation? What if inflation is going up 10% a year or whatever? Well, I've got a lease that's already locked in for, years or even a decade or two in advance. Self-storage, month to month, I can raise the rents every month if I choose to. And like I said, people will probably not leave in general. One cool thing is that a lot of these mom and pop owners think these are just little metal boxes that spit out cash. There's a lot more to it than that. And as a result, a great operator can come in and take those metal boxes and turn them into a really powerful business.
Well, I know Ryan has a question here, but one of the things that I wanted to mention here is that I've noticed this actually we just filled a unit about 6 months ago at this point, and we got our tenants on this is a single family home. We got our tenants on a 2-year lease. And one of the reasons why we did that is because we wanted the longevity they sounded like they wanted to stay, but we got what we thought was a top of the market rent. And what we realized is that it probably actually wasn't top of the market rent because of how high rents are going up. And now we're not upset or anything like this because we have good tenants in for a longer term. But to think that, if we could raise the rent after a year by 100 or whatever, 150, because of how high they're going, we can't do that now that they're locked into 2-year leases. So I like the flexibility here of the month to month. It makes sense. But did you want to go into something?
Yeah. So it seems like, I mentioned to you pre-show, we have people, probably the demographic listening, that are just from 0 to 10 units. They don't have a massive portfolio, but they want to keep implementing new ways to invest or new different property types or investing types into their portfolio. It seems hard to get into large commercial deals like self-storage. Can you tell us about the 7 different paths there are to enter this realm that you mentioned in your book?
Yeah. I spent years, like I said, trying to figure out how to get into commercial real estate. And I wasn't sure how to get in, where to get started, who to trust. And so since I've been in it for over a decade now, I've observed about 7 different paths to get into all commercial real estate, specifically into self-storage, obviously, since that's what the book's about. So the first way is stair stepping. That would be start with a small property and then, fix it up, maximize it, rent it out, increase rents, increase income, increase occupancy, do all the marketing you would with a, larger facility perhaps, and then sell it and then get up, go to a larger, asset, and then just keep doing that. So stair stepping up. Path number 2 would be being a capital raiser. Being a capital raiser is quite dangerous. The SEC doesn't really like that. So you got to do it by the rules. You got to be, a general partner or in the deal, or you got to be a broker dealer. There's a lot of ways to do that. But I mean, if you have a knack for raising capital, you guys, you're in sales. If you can raise capital well and join yourself with a great operator, then perhaps you can, learn the business that way and, jump up the business through raising capital, especially if you find somebody who's great with operations, but terrible with people. A third path would be being a deal finder. And that would be sort of like being a realtor, but you're not a realtor. You're finding deals and you're presenting them to a seasoned operator. And you've got to, you strike a deal with them in advance and say, hey, if I bring you a deal, you'll pay me X. And so that would be the third path. The fourth path would be go big. I mean, if you won a lot of money if you won the lottery or inherited a lot of money or made your tens of millions in Bitcoin before it crashed, going big can be a way to go. It's not for many people, obviously. The fifth path I really like, but it might rub some people wrong. It's get a job. I know a guy who had a really good job as a mortgage lender, and he took a 50% pay cut to get a self-storage property management job. And he did that so he could learn the business from the inside out. So if you can get a job in property management, asset management, not so much construction. Let's see what else. You could be a lender. You could be a commercial real estate broker. You get to know the people, you get to know the parties, the lingo, and then maybe you can partner up with somebody from that from those job relationships you have. The next path, the sixth path, is one of my favorites, and that is passively invest. If you've got cash flow or if you've got cash available and you don't want to continue to do hands-on, or if you just don't ever want to do hands-on, you can passively invest in these deals, or you can use your passive investments like in a syndication or fund as a bridge to learning the business to where you could get in the business yourself while you're still doing something else. So that's the passive path. And then the seventh path is one of my favorites as well, and that is hire a paid coach or find a non-paid mentor. And this is a great path in particular because a lot of people who get a paid coach find their future business partner in that mentoring or coaching program, or they maybe even partner with their paid coach or their mentor, and they start a business, with them. And so that really is a great path as well.
Love it. First of all, the way you succinctly broke that down, I think is great. Those are 7 key tools for people that, because we're talking about, we want to get into self-storage too. So one of those paths will probably work for us. My next question would be getting in is awesome, but how do you know what a good deal looks like? So that would be the next thing I want to talk about. Is there a difference in analyzing these properties than you would analyze a multifamily property? If so, what is the difference? And kind of maybe just walk us through the basics of analyzing them.
Yeah, I'll just make a point here. When we were doing multifamily, we didn't want to be in a city under, an MSA under $500,000 or even $1 million because, one major job shock, plant closing or whatever could really mess up the economics for multifamily. I'm sure that's true for self-storage, but it seems to work in really tiny towns. One of our largest self-storage assets that we've invested in is over 160,000 square feet over, is that right? Yeah, over 1,600 units. And that's in Ishpeming, Michigan. You've probably never heard of that.
Not a chance.
It's a tiny
sounds like
little
Timbuktu.
town. Yeah, it's a tiny little town in the UP in Upper Peninsula of Michigan, yet it works really well. Another one of our best investments was in Beeville, Texas, a town of 12,000. So the question is, how do you analyze these? Well, first, I generally want to find 4 things before I'll even look any further. So number one, I want to see what the square footage of storage to the number of people ratio is in a certain circle, like a 3-mile radius, for example. And so within 3 miles, I want to see, how many people there are, how many square feet of storage. And I like to see about 6 or 7 or 8 square feet of self-storage at the most per person. Okay. Because that's the national average. If you're way above that, like places like Boise, Idaho, where the square feet of storage per person is like 25, that is not a good place to be. Okay. If you're in an underserved market like downtown Atlanta, Georgia, you might find that you're in a better location to raise rents. In fact, Atlanta, Georgia was one of the top increasing rent markets in self-storage in the last 12 months. And so that's number one. You can do that analysis with a tool called Radius Plus. By the way, Radius Plus is an online tool. You can get some free hours in on that if you sign up for that. And then you can actually just use that tool to find that information. A second key driver, but probably not quite as important, would be income. You want to be in a middle income to high income area. You definitely don't want to be in a bad area, because you want a place where people with money are willing and eager to drive, to drop their stuff and store their stuff. A third demographic, I guess you'd say, would be you want a high vehicle count on the road. So you want to be on a road with, 10, 20, 30,000 cars per day or more. And then fourth, you want to be in a visible location on that road. Right across the street here, we're on a very highly traveled road, but there is a self-storage facility that's down behind a hill. And I passed it hundreds of times before I ever even saw it, I think. And so you want to be in a very visible location. Now, once you've got those 4 dialed in, there's all kinds of other things you need to do. I mean, if you're investing remotely, you definitely want to start with a Google Maps and a Google Earth search to see what else is around, and really carefully dial that in. And whatever you do, make sure you go see it in person, and don't just take a broker's word for it, for sure.
Got it. So the way I'm thinking about this, first of all, thank you for that. I'm thinking about, okay, we can analyze deals that are out there, right? And potential properties that are existing. And I want to dive into, okay, how can you, I guess, force appreciation or make these better, right? Mm-hmm. But then on the other side of things is the new development, right? Is there room for putting up your own self-storage facility, or is that going to be 10 times more expensive than going in and uplifting a property that's already existing?
Yeah, the expenses on that, they're all over the board, and it's hard to say, but there are, I would just say, Ryan, there are 4 major strategies to winning in self-storage. So one would be ground up development. For sure, the highest risk and the highest return. One of the reasons it's high risk is just the obvious construction costs and labor shortages and all the crap we're dealing with right now. But the other one is the highest risk time in a self-storage facility's life cycle is when you're trying to fill it up, to get it from 0 to, say, 90% occupied. And that is a really dangerous time, because it's possible that a national player could pop up a block away and crush you. And this is why I like investing in places like Ishpeming, Michigan, Beeville, Texas, because that's not likely, probably never going to happen there. So anyway, ground up development, highest risk, highest return. Second great strategy is retrofitting, and that would be retrofitting existing facility. A friend of mine, AJ Osborne, bought the Reno. You know about that?
No, we don't know the deal, but we know AJ.
Yeah, you do.
AJ
Okay.
would be somebody we've actually trying to look to get on the show, but we don't know him personally, but
Oh, that's great.
We know his
Okay,
work.
I saw you nodding, and I didn't want to tell the story if you just heard it last week.
No,
Sorry, I was getting excited because I know
I'm
he's
glad
in the
you were
self-storage
nodding. That's
space.
great. So anyway, AJ bought the super Kmart in Reno, Nevada. I think it was like 110,000 square feet. He sold off the parking lot to apartment developers because think about it, it's already in a great location. Then he cut the building in half to create more exterior storage. And he opened this beautiful, 2-building self-storage facility. He talked about this on the Bigger Pockets podcast, July 3rd, 2018. And in that, when he told that story, man, it was just electrifying because he was in the hospital, like really bad, like in a coma for months while this storage facility was being developed. Anyway, it opened up, and he said on the podcast that when it's stabilized, it should be worth like $22 or $23 million. Well, he only had $7.5 million in it, and that included $2.5 million of his equity and $5 million in debt. So for $2.5 million in equity, he was hoping to sell it someday for $23 million. Well, I was on the phone with AJ in December, 5 months later, when he got an offer of $26 million on it. Well, he turned that down. Now he told me a month or two ago, he's turned down other offers in the $32 million range because he's going to add a second level. It's going so well. He's going to add a second level of storage in there, and he's going to get it into the $50 million range.
Wow. It's unbelievable. The scale is unbelievable.
Yeah,
right. That's the thing that everything is all about percentages, right? And we were talking about this on previous episodes. If you go and you buy, a duplex or a triplex or a quadplex, which I'm sure happened for you many moons ago, right? But like we talk to people all the time that do that, and a lot of people think that that's risky, and in some cases it could be, but actually sometimes when you buy a 20 unit or a 50 unit or a 100 unit, if you're doing it the right way, your returns percentage wise can be so much higher, and you actually have less risk because there's a lot of reasons why you have less risk, but it's not as risky as you think it is playing in the spaces that are a lot smaller. So, we just interviewed someone the other day who Heather Blankenship, who bought an RV park for $3 million. Turn around 6-7 years later, it's worth $13 million. So some of these numbers, it's unreal. But I did not know that story about AJ. I think that's pretty wild.
That is crazy, and it's so retrofitting self-storage is another strategy. Where can you find these buildings? Well, we just invested in 2 north of Boston. One was an old warehouse or factory, and the other one was a retail strip center that they're converting to self-storage. You can also look for Kmart's. You can also look for old bookstores. I think Borders, didn't they go out of business a long time ago? There's other ones though. You can look for Toys R Us, standalone Sears stores, sometimes even a Sears store and an anchor in a mall, though I think that would be riskier, I would think. I don't know.
So how come these stores? This is so interesting because you're mentioning the area I grew up. A Kmart went out of business. Sears went out of business. A Toys R Us went out of business.
Yeah.
And Borders, they're all in like a general 4-mile radius of each other.
Yeah.
Or 10 miles. And why would you pick those specific ones? Are they fitted? I guess, is it the structure of those that storage would fit in there perfectly, or not perfectly, but fit well?
I think that's true. They've already got the HVAC systems, the roof, the flooring.
Mm-hmm.
They've already got a great location, hopefully a high ceiling. Lots of reasons to pick those, and they're a large store. It's not like a little retail restaurant or something, but it's a large. You want to get at least 30. Well, you can operate self-storage profitably at lots of different sizes, but these 50 to 100,000 square foot boxes are really good opportunity.
Let's say somebody was looking to get into this, but maybe they're on like the level that we're at, where we've kind of made a decision that there's a level of diminishing returns that it comes to buying more duplexes for us. It's just not it's just not worth it. So we're looking to get into short-term rentals is one of the things we're looking to get into, more short-term, but I'm talking about longer term. Self-storage is something we've talked about. Multifamily apartments is something we've talked about. We're not really sure the route to go, but let's say that we wanted to, bite off an apple, not too much more that we could chew. Is it worth it to play in a game? And do these exist of like 20 unit, 25 unit, 40, 50 unit storage facilities? Or is it like where a lot of the money can be made at? Do those exist? I don't know.
I don't know. I mean, if it had a great location, had lots of land to you could add to it. There's probably some factors that would make that workable. I can't imagine doing one that small.
Okay.
I mean, now they have automation, and that was one of the mistakes in my book. I really downplayed the role of automation. And I think it's, COVID has just really brought automation to a new level. And there are some automated facilities that are doing really, really well.
Can we talk about those? Yeah. Like what specifically is automation for those who don't know?
Yeah. So somebody, like, it used to be like when automation was in its infancy, I guess, you'd have to buy a $35,000 kiosk outside of your facility for people to check in, to come, and they would get a gate code, I guess, and all this. But now it's like they have software, apps that'll allow you to do it from your iPhone or Android. You can rent your unit there. You can get a gate code. You can, somehow they provide you with a lock, because they have like these approved locks they want you to use that can't be, cut through. And you can do that all without talking with a person. There are some things you can't get with automation, though. And I brought that out in the book.
But yeah, I was just thinking about like how you would go about managing one of these facilities. And like, I guess people can read it through in your book. I want to actually talk about one of your deals specifically, just so you can give people an idea of like how you got involved, and whether it was with yourself, whether it was partners. Can you talk about just like the beginning to end of one of your deals in particular, and like how you analyzed it, who you went in with, what your profits are monthly, cash flow, and then if you wanted to sell it, maybe what that would net out to be?
Yeah, you bet. So I mentioned 4 major strategies to get involved in self-storage, and we went over 2 of them. One of them is just, basically just buying a stabilized asset. But the 4th strategy is the one I wanted to talk about anyway, and that's buying a value add facility. And that would be like one with a lot of intrinsic value. And that would be like, something that has a lot of potential upside that the mom and pop owners not tapping into. And so an example of that would be the asset I mentioned briefly in Beeville, Texas. Now, Beeville, Texas, it was called Security Mini Storage, and had 606 units. And the company we partner with to do operations, they had called them, and there was 5 feuding siblings. And these 5 siblings were, their parents had passed away, unfortunately, and they were running this into the ground. They said they wanted cash quickly. And so my friend got on an airplane real quickly, and he offered them $2.4 million, and they accepted it. It had 91% occupancy, but 60 units of the 600 or so were delinquent. So it had, 10% delinquency, which I've seen much worse than that. I've seen 80% delinquency. No kidding. But there was no website, no web marketing. There were high expenses. Rents were 20 to 30% below market. And so my operating partner bought this. And when he bought it for $2.4 million cash, he found out it was on the market. He didn't even know that before, through apparently a local residential realtor for $5.5 million. But he bought it for 2.4. Okay. Yeah. And so within the first 3 months, they got 320 new move-ins, 2 rate increases. They added U-Haul, and they added other income streams like selling locks, boxes, tape, scissors, tenant insurance, other things like that. The occupancy was maintained in the low 90s. The delinquent tenants that were still delinquent at that point, they auctioned off their stuff, and they got an appraisal of $4.6 million in under 4 months. Now remember, he only paid $2.4 million for it cash. So he, for the first time, decided to put debt on it. So when he put debt on it, he put $2 million in debt. Now think about it: $2 million on a $2.4 million purchase would have been an 83% loan to cost ratio, extremely risky. But now with a $4.6 million appraisal, that debt was only 43% loan to value, the current value ratio. And so very impressive turnaround there. And a year later, he sold it for $4.6 million. And based on the average equity that was in the deal, which was, only $500,000 or $600,000, if you know what I mean, because he originally had 2.4 in, but he quickly went to 400,000 or so in the deal. Based on that, the investors, which my company was the largest investor, we got like a 300 or 400% we have 3 or 4x multiple on our invested capital.
Got it. So you were a money partner in this deal. Was there a lot of renovation work needed to get this valuation up? I don't know if you mentioned that. Was it something that needed or was it really an operational? Was it really an operational deal that increased the value?
It was mostly operational, and there was some deferred maintenance. Yeah.
Yeah.
But there always is.
Yeah. So interesting that deal can just, double it in 4 months. It's just unreal.
Yeah,
almost.
Can you even talk about some of the maintenance that you would even do or configuration adjustments, or what, how do you increase the value on certain properties like this? If you're not talking about the operations, just how can you improve them?
So lighting, security, fencing, paving, sidewalks, landscaping, all those things help, but they're not really big value adds. I mean, it's not like someone's going to come in, oh, well, I'll store my stuff here now because you have security cameras. Though that does help, especially when they're in the showroom talking to you or you're advertising on your website. But I mean, there's a bunch of value add. You want me to go through some of the value add opportunities in self-storage?
Yeah, that'd be great.
Yeah. When I first heard, guys, about value add in self-storage, I think I laughed out loud. I'm thinking, where are the countertops and cabinets? Where's the lighting and flooring and fixtures and fake hardwood floor and bark park and all this stuff you get with apartments? We're talking about 4 pieces of sheet metal, some rivets, a floor, and a door. But I had no idea how powerful the forced depreciation opportunities would be in self-storage. So let's go over a few. So for example, on that one, taking those delinquent units, the 60, and making them paying units at $125 a unit, 60 vacant units at $125 a unit times 12 months, that's something like $90,000 extra. But $90,000 at a 6% cap rate is $1.5 million in added value right there. Did you catch that?
Wow. Yep.
That's just taking it from taking that 10% delinquency and turning it into paying units. Then imagine raising the rent. He said it was 20 to 30% below market. Well, adding 20% to the rent, let's say just add 10% to the rent, $125 a unit times 500 units times, 10%, which is $12.50 times 12 months. That's $75,000 in additional income, $1.25 million in additional value at a 6% cap rate.
So right there, you put those two together, you just got your $2.4 million increase, right?
There you go. That's right.
Wow.
But I'm thinking just to raise those rents, is there anything that's done to like enhance the value of these things?
Sounds
Or
like
you're
the
just like,
management
or
of it.
they're just like, here you go. Like, we're just boosting your price up.
Yeah, I mean, sometimes it's just a price boost, and the attitude is like, well, if you don't like it, go down the street, and you'll pay about the same there, and you'll have to spend a week or an evening or a weekend moving your stuff. It just doesn't make sense for most people to do that.
So it's interesting. This asset class is actually a lot more simpler than maybe people who don't understand it would even realize. Like, you don't have the toilets, right? You don't have you don't have a lot of the things that you would have in residential units, because people aren't spending all day there. So things aren't breaking as easily, right? I mean, You're talking about boxes, right? So that is, it's very cool. Let me ask you this. What recommendation would you give someone who's not at the investor level that you're at, who's just starting out? What would you tell them as advice to maybe try to get into this game? If maybe they have some units under their belt, small multifamily, whatever it may be, what advice would you tell them?
I would say, I mean, I'm not trying to sell the book, but I would say, look, check out those 7 paths we went over that I'm detailing. The last 1/3 of the book details a lot more information about those 7 paths. And I would tell them to do that. I would consider, the possibility of trying to partner with somebody. Like, don't try to go it alone, but find somebody else who's buying these type of assets. A lot of those partnerships can be formed in masterminds and coaching programs. That's where I've seen more people come together successfully than probably anywhere.
Yeah, that's what I was thinking, is paying for the coach or the mentor, and or just getting around like-minded people that are interested in the same asset class, and join forces together, or people that have done it before you, seen success, right? That's how we see plenty of other people become successful. Right. I do have a fun one for you. And I could be totally off, but do you have any war stories or any crazy finds in some of these units?
Since we're not the operator, so I didn't really make this clear up front when I went through my history, but we got to a point in 2018 where, like, okay, we love this asset class, but we don't have a track record. We don't have a history. In fact, if we start right now, we'll end up being average. And we don't want to be average. So we thought, what can we do to partner with the very best operators we can? And so what we did is we had about 120 investors as a result of my earlier book. And we said, hey, we're going to transition into self-storage. We were scared, and we lost like one investor who said they wanted multifamily only. And then we said, but we don't have the team. We don't have the track record and the technology and the history. Why don't we go out and find the very best operators, and we'll pull together a fund, and that'll give you diversification across not only these different assets, these different operators and geographies and strategies, but also different asset classes like self-storage, mobile home parks, RV parks, even some multifamily. And so that's what we did. So circling back to your question, since I'm not the operator, we haven't found, I haven't got any great stories to tell you, but I've asked my operators that question, and they say it's mostly very boring. Like,
no dead bodies. I was hoping for something.
Nothing really amazing. One of them said they found a coin collection or something once when they auctioned it off, and they bought it, but
you want it to be boring if you own it. Like, you totally do. We wish our real estate was less boring or more boring. I mean,
yeah. So you mentioned it a few times, like creating funds and like gathering, I guess it's almost like crowdsourcing, right? So can you talk about putting a fund together and how you get people on board to jump into specific investments?
Yeah. So with our fund, it was very similar to having a single deal syndication. We just did the same thing that we would, but we said, look, we now are going to offer like one $50,000 investment will get you a piece of over 100 assets in self-storage, mobile home parks, RV parks, apartments, light industrial, and opportunistic retail. And so really it's the same steps. I mean, basically it's doing podcasts, it's writing books, it's promoting, it's just basically getting a following of people who know, like, and trust you, and then just doing webinars to announce what you're doing.
Really quick before you go into it, last one for me is, how do you decide, or how do you put this deal together for equity partners or like operators and things like that? Like, can you just give us like a quick sample of like a basic deal and like how you would pay people? Is it monthly? And then like, say you want to sell the property, how does that work and shake out in the self-storage space?
Yeah. So it's very similar to multifamily syndications that you might be familiar with. So there's typically a waterfall structure, like a preferred return. Our preferred return is 10%. That means the investor gets the first 10% a year as far as cash flow from operations before there's any split. Above that, if we ever get above 10%, it would be an 80-20 split, 80 to the investors, 20 to us. And then there's also 80-20 split on cash or cash from appreciation. And that comes at the time either of a refinance or sale. And so that's kind of typical. Typically, we charge an asset management fee of, let's say, 1.25% a year. And then, our big money is, if the investor succeeds first with that preferred return hurdle, then we get in the money after they do. Does that make sense?
Yeah, definitely
absolutely.
does. Thank you for that.
So investors can generally expect, though they're all over the board. And of course, it's going to change as the economy changes. But most investors expect similar returns to multifamily, which would be, 5 to 8% cash flow per year.
Got it.
And then total annual returns in the mid-teens annually.
Do you pay that out at the end of the year or monthly? How's that work?
So in our case, we're paying the ongoing cash flow monthly. And then at the end of the 10-year term, we're seeing, the opportunity along the way, getting toward the 10-year and at the 10-year mark to pay out the appreciation.
Got it. Okay, great. I appreciate that breakdown. And as we wind down the show, I do want to touch, I know I mentioned it briefly, but even if you don't want to sell your book, we'll try to sell your book for you. So the Storing Up Profits, capitalize on America's obsession with stuff by investing in self-storage. I'm curious what gave you the idea to write the book, because I mentioned this to a couple other authors on the show. It's one thing to be an expert in your craft, but being an author, writing a book, like that's a different thing in itself. Like, what gave you the idea, and kind of what were you hoping people would get out of reading it?
Yeah, I wrote a book about, 16, 18 years ago. Something like that, about residential real estate. And I found out all of a sudden I was the expert in Smith Mountain Lake real estate. Actually, it was 2008. And so I thought, oh, that's always a really good idea. It's something I had in the back of my mind. And when I first discovered self-storage, that weekend, I remember it was like a Friday or Saturday, I went to buy every book on Amazon in self-storage, and there wasn't very many. In fact, no offense to anybody out there, but they looked like they were home written, home edited books. And so there was one really good one, but overall there wasn't. So I decided, hey, if I ever get in this asset class, I'm going to keep that in mind and think about writing it. So I always write special reports and things like that for my website. And so I thought, I'm going to take this special report and turn it into a book. And I just started adding to it.
So first question of the core four is, what's your favorite investing or business book and why?
My favorite book would have to be, I've got a couple, but one would certainly be The One Thing by Jay Papasan and Gary Keller. You guys, man, it is, as you know, I can see from the smiles on your face that it's such an epic book. It basically taught me, I was a shiny object chaser for years. I even wanted to put serial entrepreneur on my business card. I was proud of that. It's not the best strategy. It may sound cool, but the best strategy is to learn something really well, really deeply, and stay in it. The wealthiest people on the planet often have stayed in their same type of investment or asset class since they were in their teens, like Warren Buffett. And, you just stay with that one thing and become the guru. So I love The One Thing.
That's a great recommendation. And I actually find it interesting now, especially people, I'm 30, Rise 31, our age, I don't know if it's harder. It seems harder to stay attached to one thing and to stay in that asset class, because even us, we're just getting started in this investing journey. We've already experienced a little bit of shiny object syndrome. We want to kind of like hone it into a couple things, but everyone that I've talked to, that have been doing this for a long time kind of say the same thing. Just stay in your lane. And, we're working on it.
We'll find our exact lane.
Exactly. I think our lane's changing, right? So it's thank you for that. So this question is funny because I want you to think about your younger self when you answer it, not now, because I assume we asked the question, if you had an extra, if somebody gave you 50 grand, right? We're probably going to up the number here too, because a lot of people that we interview are like, well, that's not a lot of money to me. But let's just say your 25-year-old self, if somebody gave you 50 grand of discretionary income using today as a metric, what would you do with it? What would you invest it? What would be your strategy to deploy that money?
I've told so many people, if I would have had the humility at 22 to listen to my 58-year-old self, I would have jumped straight into commercial real estate and I never would have done anything else. The opportunity to create and sustain multi-generational wealth is unparalleled in my mind. And so, I definitely would have invested it. I would have tried to find a diversified portfolio of self-storage and mobile home parks, I think.
Got it. Cool. That's a great answer. Cool. Question 3. What's been your biggest mistake that you've made along in your just investing journey, and how have you learned from it?
How many days do you have?
We got 5 minutes.
We got 3 minutes left,
guys. So I had a podcast for 4 years called How to Lose Money. And the How to Lose Money podcast, we interviewed 238 investors, entrepreneurs, business owners about their mistakes on the way to the top. And I had some. I think the biggest mistake for sure was chasing shiny objects, which I already mentioned, and speculating, which I already mentioned as well. Investing, like you said, should be boring. Paul Samuelson was the first Nobel Peace Prize winner in economics from the US. And Paul Samuelson said, investing should be boring. He said, it should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas.
Yep.
I like that.
Yeah, I love that. Great answer. So last question in the core 4. I'm curious if you have a legacy that you want to leave. What do you want your legacy to be? Why do you do this every day? It's not easy, especially to become an astute investor, at the way that you have. What do you do it all for?
Yeah. So, I definitely, there's definitely my kids involved. And as far as leaving a legacy, would definitely be a lot through my 4 kids, but that's not the answer I'm going to give you though. When I sold my company 25 years ago, I woke up with a couple $1 million in the bank the next day, and I wasn't, that much happier than I was the day before. And of course we all kind of know that, but you want to test it, right?
Yeah.
Well, I really realized over the years the importance of having a really eternal, much bigger goal than just what I, just have in front of me. And so I want to just share this with you guys. It's pretty shocking. If you took the record profits, not the average, the record profits of Apple, General Motors, Nike, and Starbucks, added those up and doubled that number, that would be the approximate profits generated annually by human trafficking. And it's incredible. And I like to believe that if I was alive in the 1800s, I would have been, an abolitionist fighting against slavery. And if I'd have been alive in or an adult in the 1960s, I'd have been fighting for good civil rights. And, this is a civil right, and it is slavery, and it's happening right under our noses. In fact, almost 600 people have been captured or sold into slavery since you and I started this podcast. And there's more slaves than any time in world history. So I'm trying to promote the cause of fighting human trafficking and rescuing its victims. In fact, our company has got a big goal of trying to free 5,000 slaves in the next 5 years.
The reason I'm pausing is because I don't know that you could have a more just cause. to get to the level that you've built your personal wealth in your company, and then to give back, not just give back, but to really help people that need it is it's unbelievable. So that's awesome. I wouldn't know that before that. We didn't talk about that before the show, so I was surprised by the answer, but it was a great one.
Thank you.
Yeah.
It's amazing.
Yeah.
That's probably the best answer we've gotten. So love it.
Oh, nice.
Thanks for doing what you do. Yeah, it's incredible.
So last segment of the show, last drop. So you kind of said this prior a little bit, but let's say you could go back in time. What advice would you give your 20-year-old self, your 18-year-old self, if they would indeed listen to your did you say 58? Your 58?
Yeah, 58. Self? I know I don't look it. I look 70 right now. I'm just kidding. But seriously, I think I would have, just really, really, I don't know if I would have skipped college, but none of my 4 kids have been to 4-year college. And I'm not saying that makes it right or wrong. I'm just saying, like, a lot of the most successful people I know didn't go to college. I did. I mean, I got a graduate degree. So, I mean, I think I probably would have went through college, skipped engineering, went straight into business, like for a business degree, and then jumped right into commercial real estate. And if they would have had a real estate degree at the time, which they do have those now, I would have totally been all over that.
Love it. Great answer. And first of all, we want to thank you so much for coming on.
Yeah.
We got a masterclass on self-storage, and I think people they'll be able to look back, point back to this episode if they want to learn more about it. If people want to get in touch with you or they want to learn more about you, what's the best way for people to do that?
Yeah, the best way would be to go to Wellings Capital. That's WELLINGS, wellingscapital.com. And if they want some free stuff like some, self-storage, mobile home parks, special reports, etc., they can go to wellingscapital.com/resources.
Love it.
Awesome.
Thanks so much.
Thank you so much.
Oh, you bet. It's great to be here, guys.
Thanks for tuning in this week to the Weekly Juice Podcast. If you liked what you heard, please leave us a 5-star review on Apple Podcasts, subscribe, and share with friends. The more ratings we get, the more ears we'll get on our show, and in turn, we'll be able to provide you with more high-quality guests. You can also find us on Instagram at Weekly Juice Pod, where we post daily tips and tricks and document our own journey towards financial freedom. Make sure to tune in every Wednesday to get your weekly juice.